share your screen and you can start presenting and you can introduce yourself. Thank you.
Yeah, thanks, Sharon. Good afternoon, everyone, and welcome to this webinar and this exciting journey in terms of investment opportunity. It's thundering and storming where I am, so hopefully the background noise doesn't get to us. So let's begin promptly. What we do, let me just run through the presentation. I think it might answer most of your questions because we've done this a couple of times, so we've refined it, as we went along. And then post that, we open it up to Q&A. Sharon can man the chats for us in terms of Q&A, and then we can open it up and hopefully answer any questions you have and address any concerns that you might have. So we're here today to talk about the Renewable Energy Fund, but it's a fund that's targeting the retail sector. So retail sector means individual investors, smaller investors. It's not really looking for bank money or institutional capital, right? So if you look at it, it's, if you think about what we're trying to do here, right? So we put this vehicle together to allow you to access renewable energy assets. If you think about the renewable energy space, it is booming. We've obviously been closely watching the story when we had load shedding, and it was close at heart in terms of what was happening, and the frustration was there. And you'd see it in the newspapers about solar and these advertisements. But even post load shedding, the space is still growing. There's a structural growth driver that's continuing in the space, and especially where the fund is focused. The fund is focused on this commercial and industrial space. I mean, that space is still growing because there's a number of drivers that's pushing that. So today we're talking about a fund that we've positioned to allow individual investors to come into that space, to partake of this very good returns that you're getting from this asset class. But also it's got a very good tax wrapper, right? So we talk about this tax efficiency, and we'll mention it in a few slides and unpack it for you. But it's got this very good tax wrapper in it, which allows you to basically claim back your investment from SARS. So effectively what's happening is SARS is paying for your investment into the fund. The returns, I spoke about that. If you look at the asset class itself, it's very good returns. And that's why even beyond the tax, or besides the tax, the asset class itself warrants a good look in terms of having it in the investment portfolio, because of the superior returns, the cash-rich nature of the asset, the low risk from a technology point of view, from an operational point of view. So if you look at it, the whole thing together, it's a very de-risked investment, right? It's de-risked on a number of legs, and we'll chat about that. But the one is that you're getting your capital back from SARS in the first 2 years. We're targeting the first 2 years. So even before taking any operational risk at the asset level. So whether the asset performs, it doesn't perform, you're going to get that tax refund back. And as I said, I'll explain that a bit further. And the important thing is that it allows smaller investors to get into this space. Because if you look at what you've got from an investment point of view, in the renewable space, there is very little, if not any, investment vehicles, right? If you look at the listed stock exchange, there's no investment vehicles. I mean, the closest we've got to an energy company is Sasol, and they not really an energy company, that moved more into chemicals. So for individual investors who wanted to play in that space, and that's how our journey started, where we had individual high net worth individuals saying, look, I've got 2 or 3 million rands, can you get us into a project? And we found that very difficult. And this gives you a nice package solution to be able to play in that sector. And you've also got the other benefits that you get in terms of the tax benefit, but also the diversification across different projects. I think before we go into that, let's introduce who Entropy Advisory is, right? So Entropy Advisory, we're a corporate finance firm. We've got a fund management business, and this forms part of our fund management business. We're a level 1 B company. We're one of the few non-white and Indian companies in this space. As I said, we're fully level 1. There's a strong team. that's sitting in this entity, a strong senior team of about 5 members that have come from different areas in corporate finance, from R&B, from Deloitte, from PIC, from UBS, from Nedbank. So it's a broad range of senior execs that have come out of corporate finance, have come out of fund management, and we formed this business. There's obviously juniors, analysts, and graduates that we've got in there as well. In terms of the offering, as I said, we've got the corporate finance business where we do advisory, we do structuring, we do M&A, we do capital raises, but we've done a fair amount of work in the renewable space. So we're sector agnostic, but in renewables, we've closed transactions, so larger scale transactions, sub-utility and utility scale transactions. And therefore, as I said, the two drivers in terms of being approached by individual investors saying, look, we want to invest in the space, and our track record and understanding of the space led us to the fund. So there's a lot of a lot of skills, but a lot of knowledge in terms of this renewables energy sector and the fund itself to be able to deliver the returns that we speak about in this presentation. We've got a technical partner, so it's a strategic relationship that we've got with LTM Energy. So LTM Energy has been in the game for almost 15 years, so it's not one of the newer companies that have entered the space because of the opportunity. They've been focusing on the commercial and industrial space. They've done work for blue chip clients like Vodacom, like Telkom, some of the telcos, some of the banks. And as I said, they've really been a leader in the space. And it talks to the fact that they've won a number of awards over the history. Just in 2024, there's been about 3 or 4 awards. In fact, I need to update that because there was another 2 awards that they won post what I've got listed there just in 2024. So it's a strong, credible partner. It's a strategic relationship, as I said, so it's not an exclusive relationship, but we've got access to obviously the pipeline of projects, where there's projects that we have, we get them involved. So the point being is that you don't just have this financial acumen, we've got this team with the technical experience to be able to assess projects, to be able to deliver projects, to be able to execute on them. So this is part of what I was talking about. You've got this credible, experienced team. You've got engineers in the team. We've got scientists. We've got the financial acumen. We've got accountants. We've got MBA skills. We've got CFA skills. So across the whole team, there's a very well-rounded capacity, right, with different members sitting in not just the financial field, but also engineering, the project management, the execution, the operations management team. So coming back to the fund, there's effectively 2 main reasons. And if I leave you with one thing today, this is it. There's 2 main reasons why you should be looking at this fund, why it's really key to have in your portfolio. The number one thing is that it's going to save you money through tax savings. Right? The last thing anybody wants is to pay tax. We want to reduce our tax burden. So this is one of the SARS mandated tax structuring tools, right? So everything's above board. It's allows you to reclaim your investment back from SARS, right? So as I said, it's a SARS mandated investment scheme. They've done it to catalyze and incentivize investments in the renewable energy space, because obviously we had this period of persistent load shedding, and this was their mechanism to attract investment in the space. So you've got this massive tax benefits, right? So effectively, as I said, it's saving you money through tax savings, because if you've got a tax burden, you're going to be paying that tax over to SARS either way. With this fund, it allows you to claim back, to claw back that tax through these tax refunds that you get. And I mean, the process is fairly simplistic. It's we'll give you a tax certificate when you're filing your taxes. If you a PAYE individual, you'll get a tax refund that happens fairly quickly. And they've run investment schemes like this. This is SARS. So the process is well defined, it's well refined as well from there. So there's not long documents that you need to submit, and it's a very efficient process. But the important thing is, as I said, the fact that you're starting from a negative base because you've got a tax liability. You need to pay that tax over to SARS. So if you're looking at investing, take a figure 500K or 1 million rands into the fund, you're going to be paying that 1 million rands over to SARS. So you're starting from a negative 1 million rand base. This allows you already in the first 2 years to get that 1 million rand back, right? So from a negative 1 million rands, just through your tax reduction, you're already in a net positive position. And as I said, it doesn't depend on the underlying performance of the assets. But then comes the second point. You're investing in the fund, and what the fund does is it invests into renewable energy assets, which I'll talk about in the next slide. And these assets make money. And most of that is cash that goes to the bottom line because there's very little expenses. And that's distributed through to the investors. So besides getting your tax money back, right, and leaving you in a net neutral position, as I said, you got all your taxes back, you're going to make money out of this. You're going to get cash distributions every 6 months. And if you look at the cash yield of the life of this product, it's a 15% cash yield. It's a very cash-rich asset class. Cash distributions every 6 months, very low risk in terms of technology. It's well understood. If you're putting in solar panels, for instance, you put on the solar panels. It's not a manufacturing facility where you need to operate it and run it. It runs on its own. There's warranties that sit behind all the equipment. So if there's any issue behind any equipment, it's changed, it's replaced, the warranty kicks in. And we're monitoring it continuously because that's what the fund does. It monitors the asset as well. And the client is billed on a monthly basis. So if I go into some of the characteristics of the fund, so as I said, what is the fund going to do, right? So you're investing into the fund, you're getting a tax benefit back, and then you're going to make money on what the fund invests into. So the fund invests into renewable energy projects in South Africa and in the business sector, in the commercial and industrial sector. So the client needs to be commercial and industrial. So we're not putting in solar panels in Joe Soap's house. We're doing it in business premises, in warehouses, in conference centers, in manufacturing plants, in mines. That's where the asset's going into. So there's lower credit risk. It's obviously we run a credit screen. We do a lot of due diligence work before we decide to invest in a client's project. But the credit risk is lower because it's a business with track record. It's a business with financial records that we can see how they've been tracking, how they've been performing, the strength of the balance sheet. And we make that assessment before we putting in the assets. But as I said, what the fund does is we'll pay for the equipment. So we'll fully fund the equipment. We'll procure it. We'll install it, as I said, through our technical team or through LTM, for instance. And then we'll operate the assets. We'll own the asset and we'll operate it. And we'll bill the client based on their electricity usage. So we'll lock into a long-term power purchase agreement. And that dictates what the rate is going to be in terms of cents per kilowatt hour or rand per kilowatt hour. So the client already knows upfront what he's going to be paying for electricity, and the annual escalation is fixed. And the power purchase agreement might run for 10 years or 12 years. So the term varies depending on the client. But it gives you certainty in terms of annuity income. You know what you're getting. You know what your annual escalation is going to be. So from an investor point of view, you can have good sight in terms of what your cash flows are coming out of the investment. From the client point of view, it's almost a no-brainer. He's putting in zero capex. He's not putting in a single cent. He's getting the asset, and almost 100% of the time, it's cheaper than Eskom, right? So you start off being cheaper than Eskom. He locks in the rate. He locks in this cash savings. He doesn't have to operate. He doesn't have to worry about anything as he's paying Eskom. He's paying every month. Same thing here. He's paying us every month for the electricity that he uses, and his annual escalation is fixed. Whether it's 6% to 8%, and that varies, as I said, per project. he knows what the escalation profile is going to be. Whereas with Eskom, in 1 year it's 20%, the next year 30%. So there's no predictability. And obviously clients like that. I think what it also gives you, remember I mentioned that doing it through a fund, and it gives you diversification. So you're not concentrated in one project. You've got diversification across a number of projects, and that gives you, lower risk, right? Because if one project really performs well and other project, maybe there's a lot of rainy days, for instance, it's not performing as we expected in that year, your cash flow profile, you don't see this big impact because you've got diversification. But we don't have diversification just across projects. We've also got diversification across different technology types. And I'll talk about that when I get to key differentiators. So what we're looking at doing is raising 200 million rands. We've got commitments for about 40 million. So, we a good way there. We'd close it, whether we either raise 200 million rands or whether we get to a point in time where we feel comfortable and we can deploy. So at that stage, we will close the fund. So it's not going to be an open-ended fund. We will close it at a certain stage. So the window of opportunity is limited, right? It's not something you can look at in 6 months and 8 months' time, just because of the fund close, number one. But number two, the incentives, the tax incentives aren't going to be there. And I'll chat about that when I talk about the 12B incentive. But if you look at our differentiators, this fund's differentiators, the one is as the technology offering. Everybody's been focusing on solar, and for certain good reasons, but nobody has the mix that we've got. We've got technology opportunities in conduit hydro, in biomass. And the good thing with these technologies, conduit hydro is basically mini hydro, where they put it in waterways. But the good thing is it gives you baseload power. Baseload power at a very good return, right? Much better than solar. So by investing in this fund, you get access to these other technologies with superior returns and generally lower risk profiles. So as an investor, you benefit from all of this. And then, as I said, we've got a strategic partnership with LTM Energy. So where we do need the technical skills, we've got that readily available. We're not just a capital provider in the market. We are a capital provider with a technical partner. We understand the business. We understand the technical business. I myself am a chemical engineer before doing a number of finance degrees and moving into finance. So, and we've got that even in Entropy in the team. We've got scientists, we've got other engineers, we've also got CAs and MBAs, and we've got LTM with a strong engineering background, accredited team, engineers in there, electrical engineers, and all certified, national bodies, certified in terms of qualifications. So that's a big differentiator we bring. So we know what we are doing. If I talk about some of the key investment highlights, right, some things to take a note of. So I've been asked this a number of times, what is the minimum and what is the maximum investment? Quite simply, minimum, we've kept it at 200K, and it's quite a low investment amount. Maybe some of you who don't think so, but there's, generally funds are looking at a 1 million rand plus, right, as your initial buy-in. So we've kept it lower to allow this smaller investors to come in. So we want it to be broad-based. We want small investors to be able to come in, to participate in this, and to get the tax benefit. So minimum is 200K. The maximum is anything. Probably 200 million rand is your maximum, right? If you want to be the sole investor in the fund. I would say, look at your tax liability. So we've got a tax calculator that can help you with that. So if your tax liability is 500K, is 2 million rands, I think that's really your target, right? Because you want to get close to that as possible. Because as I said, you can claim all of that taxes back, right? So if you've got a 500K tax burden, why do you want to pay the full 500K to SARS? If you invest the 500K in this fund, you can claim that back, right? And as I said, we've got a tax calculator, so just reach out to us after the call. We've got a tax calculator that can help you to calculate that. And we're obviously available, the team's available to have that discussion with you. It's a 10% deposit when you register in the fund. So to secure your place, it's a 10% deposit. So even if you've decided to invest R1 million, it's just 10% of that you need to commit up front. And then we do capital calls thereafter for the projects. But be cognizant that we are towards the end of the year and we've got project pipeline. So those capital calls are going to be fairly quickly, right? So if you do want to invest R1 million, for instance, I think those need to be fairly liquid, right? But as I said, from a risk mitigation point of view, you're only putting in 10%. And then the rest we're calling down. We will give you details about the projects. You know it's definitely going into a project, and that's why we're calling down the capital. It's not you giving us the R2 million and we're sitting with it, right? I spoke about what that capital will be used for, as it will be used for investing in renewable energy assets, will be diversification, and we're looking at returning invested capital within 2 years, right? Mainly through the SARS tax mandates. And as I said, the good thing with that is that it doesn't depend on the operational performance of the asset. What it does depend on, though, is that you need to deploy that capital. And that's why I said we are towards the end of the year. We will be deploying that fairly quickly. We've got projects already that we're going to deploy into. So if you deploy that capital, you are eligible for that tax refund. Right? And hence me saying, once we draw down the capital, you know it's going into a project, and you know you're going to be admissible for that tax refund. So we're looking at return of invested capital within 2 years. So if you're investing R1 million with us, within 2 years, you've already got that R1 million back, right? So you de-risked completely. But besides that, as I said, you're going to get this return from year one, right? You're going to get cash distributions every 6 months from year one. And what that leaves you with is, I mean, in financial speak, we talk about IRR, but a pre-tax IRR of over 50%, which is immensely good. But in terms of money back, you're going to get almost 3 times your money back through the life of this fund. It's, as I said, if you look at the cash flow profile, it's annuity income. So basically, you're getting cash distributions every 6 months. Getting cash, it's not dependent on us selling the asset at the end of the term. It's not dependent on some event that happens. You're getting that cash, and that cash grows either through inflation, depending on what we've made the annual escalations in the PPAs as, or above inflation, right? So you're getting at least inflation increases, but most likely, that's how we've structured most of the projects, is that it's above inflation increases in terms of your cash distributions. And that's why I said, if you look at the average cash yield, it's about 15%. So you're getting all your money back within 2 years, plus over and above that, you're getting 15% cash returns, cash yield, just on that initial investment. I think it's worth mentioning that because it's an equity fund, so as I said, we own the assets, we invest in the asset, we own 100% of the asset, we invest 100% of the capital in the asset. It is Sharia compliant. So we spoke a bit about this tax benefit, and you might have mentioned it's a 12B tax benefit, but what exactly is this, right? And I'd like to unpack it here. It's, as I said, it's SARS mandated tax incentive. And look, SARS has a number of tax incentives across different sectors, be it manufacturing, in energy sector, in R&D, for instance. So these tax incentives are all over the place. They do exist, right? But what they've done is they've supercharged it for last year and this year. They've allowed you to claim back 125% of your investment as a tax deduction. And I've got a table in the next slide that really gives you the picture firsthand. But what it means is that if you invest 100K, or let's say 200K, which is the minimum investment, you can claim back 1.25 times that as a tax deduction. And therefore, it is your best tax structuring tool out there in the market right now. The others generally are 100% at most. This, as it gives you 125%, and it allows you to claim more than that because it allows you to claim in the second year as well. And I'll talk about that in the next slide. So what happens after next year? Does the tax fall away? it doesn't fall away. It goes back to what it was prior to that, which was 100% tax deduction. So that's why I said in these 2 years, they've supercharged it. They've said, okay, it's normally 100% tax deduction. We're taking it to 125% because we want to alleviate the load shedding that we're having and we want to incentivize investments into the sector. And I must admit, it's worked. So this is the last year to get the 125%. Next year, it goes back down to 100%. And as I said, the key is, if you look at the last point, the project must start producing electricity. So in other words, it must be commissioned this year. So it's not us you investing in the fund, and we can invest in 3 years, 4 years time, right? And therefore, you've got good line of sight, you've got good returns profile, because whatever capital you're investing in the fund, we need to deploy it immediately, and you get the benefits immediately in terms of the tax deduction, number one, but also the cash flow returns, the returns that you're getting on asset from basically year one. So I was talking about this table, and this gives you a good picture in terms of what it means to invest in the fund from a tax deduction perspective, and what it means if you weren't invested in the fund. So if you look at the middle columns in, what is it, gray or green or greenish gray, that talks about an individual who wasn't invested in the fund. So his taxable income is 5 million rands. Doesn't invest in the fund, therefore doesn't get any tax deduction. So at the end of the year, whenever he's filing his tax returns, whether it's provisional, whether he's, as I said, PAYE, he is going to be liable for paying tax on 5 million rands. So the tax due at the end of the year, assuming his 45% marginal tax rate, is about 2 bar, just over 2 bar. So he's going to pay that amount over 2 sums. On the right, that scenario is an individual who is invested in a fund. Again, he's earning 5 million rands, or his 5 million rands is taxable income. He decides to invest just 1 million rands into the fund just in year one. So he's done one single investment this year in year one of 1 million rands. As I mentioned, what it allows him to do is reduce his tax base by 1.25 times that, 125% of that in this year. So I'm not sure if you can see my cursor, but he moves from a tax base of 5 million rands, it's reduced by 1.25 million rands to a tax base of 3.75. So he only pays taxes on this. This is obviously his tax liability for that year. So he's getting a saving of 500K or 560K, almost 600K in year one. In year two, what happens is, because we bring in leverage at the asset level, not at the fund level, but at the asset level, so therefore there's no recourse to investors, it allows you to claim back another 1 million rand tax deduction, right? So remember I said 12B still continues next year. It goes to 100%, so it's 100% of your initial investment. So it allows him to claim back another 1 million rands. His tax base drops from 5 to 4. Then he pays taxes on that. That's what he pays versus what he would have paid. And he's got a tax saving of 450. So just add the two together, you're over your initial investment amount of 1 million rands. And that's why I'm saying, just through the tax deduction, through one single investment, you can reduce your tax base over the 2 years by 225%. So this 225% of 1 million, that's how you get the 1.25 and the 1. And you're getting this resulting tax saving that's more than your initial investment. And as I said, that's a refund that you'll get from SARS. You'll submit your taxes, SARS will give you a refund, go into your bank account, and that's almost done and dusted. I mean, this just shows graphically, how your cash flow yield looks. I think the key is the graph on the left-hand side. As I said, you do your initial investment, get your tax refund in year one. Remember, you're still getting a return from the asset still in that year. Then you're getting a further tax deduction in year two, and you're getting the cash distributions then every year, right? So from your initial investment, you've got, remember I said you start from a negative base because you would have paid the taxes either way. You're almost 3 times getting your money back. So we've run it as a 10-year fund. There's potential for liquidity events in between, and we're investigating some of that. If you do need to exit before that, the fund will consider it on a case-by-case basis. But the reality is, if you're getting all your capital back in the first 2 years and you're getting a free cash distribution thereafter, I would just run it until obviously the end of term. I think just shows you in terms of actual numbers on tabular form, how it works, and the numbers that we spoke about. So as I said, in year 1, you're getting a tax refund. So if you look at your investor, he's invested R1 million. He's sitting at a 45% tax base. In year 1, he's getting his tax refund back. Then there's a distribution from the asset. In year 2, he's getting the tax refund back again from SARS, distribution in the asset, and that just continues until the end of the life of the fund, where if there's any tail, the asset will liquidate it, so we'll sell it. We've got pension funds that are already on board to buy the asset because they like the yield income out of it. The construction risk is finished and complete, so it's de-risked for them. So it's a very efficient, quick way of exiting the fund at the end of fund life. So I mentioned, you're looking at almost 3 times money back on a pre-tax basis, and that's net of fees. So after whatever fees need to be paid to the fund manager, you're getting almost 3 times your capital back from this R1 million investment. Over the life of the fund, you're going to get about R3 million back. I mentioned that the money needs to be deployed into projects, and if you think about the projects, we've already got a healthy pipeline of project, and we're building that almost every day. We've priced in the market already R1 billion of projects just in this year so far, and because we're quite prominent in the space. So as I said, we've been doing advisory work in the space, corporate finance advisory work in the space. We know a lot of the players in the market. We've got a good funnel in terms of projects and good network in terms of attracting projects and getting projects. We've quoted, just in this financial year, close to 30 projects. The last month, 4 projects alone. And the project size are fairly well-rounded and chunky. So average project size of about 60. If you look at our mandate of the fund, we do smaller projects in up to R1 million and above. But because of our good relationships in the market, good networks in the market, our good pipeline, we're able to attract good projects that are reasonably sized. The risk with these smaller projects is that they're very small. There's a lot of risk with them, a lot of technical risk. Plus, with the smaller projects, generally, it's for smaller clients. There's a lot of credit risk. The good thing with the bigger projects is that the returns are better, number 1. Number 2, generally, the technical risk is a bit lower. And number 3, your client is generally a blue chip client. So we've got blue chip clients with low credit risk. And that reduces the risk for the investors in the fund. So the procedure to invest, and it's worth mentioning that who can invest. So as I said, it's targeted at taxpayers. And whether it's an individual, you're coming in your individual capacity, or whether you've got a trust, or whether it's a company or a sole proprietorship. So your legal structure could be anything. You could come in any form. It still allows you to invest and allows you to get the tax benefit. Whether you're a company, whether you're a trust, you still get the tax benefit. So in terms of the procedure to invest, it's to, either you can reach out to us, we can email you the form, you can download it from the website, complete the application form. There's obviously FICA documents that you need, the 10% deposit, is investment confirmation. And then as I post that, there's the capital calls where we do the drawdown on the capital. I don't have a slide on this, but it's worth mentioning, and maybe I'll go into the next one so we can round it off, is that this is a registered fund. It's not something we've coupled together. It is a registered fund. We've got an external administrator, which is Grovest, so a known name in the space. a known name in fund administration. We've obviously got auditors, so it's a fund that's FSCA has oversight on. We need to lodge audited reports with them. We need to report back to them every quarter. So it is a regulated, registered fund. And it gives you, and that's what I'm saying, if you look at the risk mitigants, it's a registered fund with the FSCA. The manager is obviously registered with them. We've got an external administrator that oversees all of this, oversees obviously the flow of capital, the auditing. We've got an auditor that does all of this. We've got a compliance department, an external compliance company that looks at the compliance of the fund and have we adhered to FSCA rules, have we adhered to money laundering rules. So you've got a whole compliance department that looks at this. The fact that it's just a 10% deposit, the drawdowns happen, the rest of the money sits in your bank account, the drawdowns happen when it goes into projects, and then your tax benefits are being triggered. There's a lot of mitigants to protect you as an investor. And we're happy to discuss that even further, right? So to conclude, and I know it's been more than 30 minutes, but to conclude, you can see I'm very passionate about this sort of thing. This is a unique investment in terms of allowing smaller individual investors to play in the energy space. The fact that it's got this tax wrapper, that you've got this limited window of opportunity in terms of a sales mandated tax refund, it gives you the superior returns to play in a space that you don't have other vehicles to enter into,